Hi, my name is Philip Hines. I'm the founder of Tonus Capital. We've been in business for 15 years. We manage a mutual fund. I'll explain a little later what's a mutual fund. And I'm also a teacher at Concordia University. And the goal of the presentation today is to, one, explain to you why it's important to start saving. Two, the type of investments you can make. And three, a few steps if you want to start investing on your own that you can follow to start your investment career. So let's start. So why should you save? It's very important to save and start saving young to give yourself a lot more options and a lot more liberty in the future. If you have some savings, you have a lot more options if you want to buy something like buy a car or buy a house, if you want to travel, if you want to take a year off from working, or if you want to start working early, you really have the options if you have the savings. And to grow your savings, you can invest them. So investments is one of the options you have for the money you are saving. There are three main types of investments, of categories of investments. You can keep it in cash, you can buy bonds, or you can buy stocks, and we'll see what each of them are. Of course, the more risk you're willing to take, the higher the potential gain you can make in the future. If you don't want to take any risk and want to be sure to keep your money, well, the returns that are going to be provided, given by the lenders or the products, are going to be lower than if you're willing to take a little more risk. So more risk, more return potentially. Less risk, less return. If you have the discipline to start saving young and you do it every month, well, it really grows into large numbers, and it's quite interesting to see what can happen if you only save $250 and per month and you start at a young age. So if you save 250 and you can invest it at 8% per year, after 1 year, you'll have $3,400. After 5 years, you'll have 18,000. After 20 years, you'll have 150,000. And you see, after 50 years, you'll have 2 million. Put it graphically on the right. If you start at 20 and you can save 250 per month and you invest it at 8%, by the age of 60, you're going to be a millionaire. So that's quite interesting if you start early. The later you start, the later the growth of the curve is going to be smaller. So start early. 250 might sound a lot of money right now, but when you will start working at the minimum wage right now, if you have a normal work schedule, you'll be making around 2,500 per month. So $250 is a small portion of that. I know it's not easy, but if you have the discipline and you invest it long term, you can become a millionaire by the age of 60. So where can you invest that money? So option one is really keeping it in cash or investing it, leaving it at the bank. So you can take your money, invest it in the bank, and after a year, the bank will your money will still be at the bank, and the bank will pay you a certain interest for having given them their money for the period of time. So in our example, you can if you put $1,000 in your bank account, after 1 year, your thousand is still there, and the bank will have paid you $17 in interest. There are so it's not a lot, but it's the risk of losing that money is there's no risk. So your money will be in your bank account in a year from now. There are two types of accounts. Yeah, there's the checking account that the banks offer. That these accounts usually have no interest, so you earn nothing. Or you can look for savings account, and right now most of the banks are offering 1.7% for savings account. So it's not enough. It's not 8% to get to the $1 million, but it's better than getting nothing on your money. Option number two is to buy bonds. So a bond is a financial contract between a lender and a borrower, where the borrower takes the money and promises to repay the borrowed amount plus a certain amount of interest. Think of it as when you're going to want to buy your first house, you will likely need to borrow money from the bank to pay a portion of the house. So you promise the bank that you will repay the money. The bank will lend you the money at a certain interest rate. And every year you will be charged by the bank a rate. So you'll pay that interest and you'll pay a portion of the borrowed money. And after 15, 20, 25 years, you will have repaid the borrowing and all the interest over time. If you have if you have enough money, you can become the lender. So you can take your money and you can lend it to governments, you can lend it to companies, you can lend it to individuals, and the borrower will repay you the amount of money that you lend them, and they will pay you a certain amount of interest. So in our example, you lend $1,000 to a borrower, and after 1 year, the borrower repays the $1,000 and is giving you $80 in interest at the 8% rate. There is always a risk. It's possible that the borrower will not repay or will not be able to repay in time the money. So you get a higher interest than leaving your money in the bank account, but there is a risk that you may not be able to recover the money that you lend to the borrower. Few examples. The safest place to lend the money is lending it to the Canadian government. So the Canadian government has the ability to print money if they don't have enough. So there will always be enough money to repay their borrowing. So the federal government is always the safest place to lend money. Right now, for a 5-year term, the Canadian government is willing to pay a 3.2% interest rate. You can also lend to the provinces, so you can lend to the province of Quebec. It's a little more risky because they cannot print their own money, but you will get 3.75% per year in interest. You can also lend to companies. So here, example, Tim Hortons is a company that's well established, has been in business for many years, generates a lot of money. So the risk with Tim Hortons over 5 years is quite low, but they're a bit more risky than the government. So they're offering 5.4%. And you can go a lot more with a lot more risk. I put here company Lion Electric Buses. This is a newer company. They have less of a track record, of a history. They make less profits. So the risk that in 5 years they will not be able to pay back the loan is higher. So they need to pay more interest. So the lenders want more in exchange for that risk. So with them, you can get about 13% interest rate on lending them money. So you see that the higher the risk, the higher the return that you can make. Finally, you can buy stocks. So what is a stock? A stock is a small ownership in a company. So you can become part owner of a company. It's not all companies that are public, so you cannot buy pieces of every company out there. For example, our company Tonus, we're not public, so you cannot buy shares in Tonus. If I take ISO or La Cage au Sport, they're fun companies, but they are not public, so you cannot buy a portion of these companies. They are private. But there are plenty of companies that are public. Most of the large companies are public, so they've decided to put all to let their shareholders, let their owners trade their shares if they want to on the public market. So the Canadian companies they are trading in Toronto. The U.S. companies they are trading in New York. So if you want to buy a piece of a company in the Canadian or U.S. company, you can with your account you can buy shares in these companies and become a small owner of these companies. Before we move on, if you buy a stock, what do you get in return? So you buy it today. Every year, the companies are going to pay you a dividend. So you get some money that the companies, so part of the profits, the companies are giving back to their shareholders. So you get a certain amount of money back every year. And when you sell your shares in the future, hopefully you can sell them at a higher price than you bought them for, and you can make a gain on that transaction. Let's use an example. McDonald's, it's a public company. One share of McDonald's was trading at $296 on December 31st. So there are 725 million shares of McDonald's. So the company is divided in many small pieces. So 725 million pieces. What's the total value of McDonald's, of the pie? The total value of McDonald's is 725 million shares times the price on December 31st, so $296. So McDonald's is worth $215 billion. It's a very large and very valuable company. So if you want, you can decide to buy one share of McDonald's. You buy it for $296 on the market. And you can buy more shares. There's one individual, the largest individual owner, John Rogers. He owns 88,600 shares. So his ownership in McDonald's is worth $26 million. Every year, McDonald's pays a dividend of $6.68. So you'll get $6 back from McDonald's. And if you buy at $296, hopefully you can sell it at a higher price in the future. This is the history of the stock price of McDonald's. So it's been a good stock. It's been going up over the past 5 years. So in 2018, if you could have bought the stock for $175. You would have received the $6.68 of dividend every year. And today, that same stock would be worth, you could sell that stock for $296. So you would have made a pretty nice return. Over the long term, it's important when you buy stocks because they move up, they move down. You need to have a view of keeping them for a long period of time. The risk with stocks is to buy today, the stock goes down and you sell lower and you lose money. But over the long term, this is a graph of the last 325 years of the US market, the 500 largest companies in the US. You see that the trend is clearly up and to the right. So it's going up. If you invest in the stock market today and you're long term and you keep your money invested in the market for the next 20, 30 years, there's very high chances that the market will be higher in that time frame. So it's a long-term game. You need to have a focus for the future, but really the long-term future. Some examples of public companies. So I said earlier, there's plenty of large companies that are public. So these are all examples of public companies. So as investors, you can look around, you can look at what you like, what you think is going to be great in the future, and you can buy shares if it's publicly traded. You can buy shares in that company. So even some sports teams are public companies. So let me ask you what you think is the largest publicly traded company. What's the largest company in the world? I'm going to give you 5 seconds to think about it. Okay, and the answer is Apple. Apple is the company that's worth the most in the world. As of the end of last year, it had a $3 trillion valuation. Huge company. Microsoft, Google, Amazon are all big companies. In Canada, our largest company, the company that's worth the most in Canada is the Royal Bank. So is Apple the largest company, or is worth the more because it has the most sales? Because it sells the most amount of products? No. Okay, the largest company by sales is Walmart. Walmart sells more, but Amazon is also number 2. So these two companies sell a lot of products. So the value of a company is not necessarily tied to the amount of sales that they have. It's more related to its profits. And what are profits? You sell products, you make revenues, and then you have your expenses. So you take your revenues, you deduct your expenses, and what's left at the end is the profit. So how much money is left from the sales? So for in Apple's case, by paying its employees, paying for the hardware, the products. So what's the profit left at the end? So Apple is the most profitable company in the world. It has profits of $115 billion per year. So it's really that reason, for that reason, that Apple is the largest or the most valuable company right now in the world. So if you if we look at the share price of Apple on the next slide, Apple has been a fantastic stock over the past 10 years. It was worth about $20 10 years ago, and now it's about $200. So if you bought shares in 2014, you made 10 times your money over that period. That's an amazing return. And the reason why the stock price moved up from 20 to 200, on the next slide, we see, look at the pink line on the graph. The pink line is the profits that Apple is making. So you see that clearly the profits have followed. So profits are also up 10 times, or maybe even a bit more than 10 times. So over the long term, the stock price is going to follow the profits. So if you invest in Apple today at around $200, you have to think in the next 5 years, 10 years, and that pink line continue to go up? Can they continue to make more profits? So can they continue to keep the same market share and can they continue to sell the same amount of phones that they are selling right now? Can they continue to raise the price that they're charging for the phones? Can they come up with a new product that we don't have right now from Apple? So we don't know the answers to these questions. There are clearly risks when you're investing in the stock market, but you have to think about the potential that the company has to continue growing its profit for the next few years. The graph here shows what happens in real life and what happens on the market with the value of the companies. So if you're a private company, you're hoping or you're trying to grow the value of your company every year, and the blue line represents the kind of steady increase in the value of companies over time. If everything goes well, it's going to be pretty hopefully a linear increase in the value. The stock market, on the other hand, the blue line, the green line, is a lot more volatile. So sometimes the market will go up. Investors are excited. They're paying up. They're pushing the prices up. Sometimes it's the opposite. Everyone's pessimistic. The prices are coming down. So the prices of stocks go up by 1%, 2% in a day, goes down 5%. Clearly, the real value of a company doesn't move this fast on a daily basis. But on the market, you see, on a live, the value that the investors are putting on the companies. So the work of an investor is to try to determine what's the real value of company, what's the blue line, and then look at the market, the green line, and try to buy the companies when the green line is below the blue line. So when the market value is below where it's really worth, and sell when the value goes above, then you want to sell your stock in the company. So it's hard because the blue line, nobody knows really where the blue line is. But as an investor, that's your job, is trying to figure out what's the real value of this company. Because it doesn't always go right, it doesn't always go up. This is an example of Pfizer. Pfizer, they make the COVID vaccine that we used a couple of years ago. So in 2021, when they came out with a vaccine, everyone got excited. The stock price went up. People thought that the profits of Pfizer would go through the roof, and every year they would have more vaccine sales. But it ended up that less people are getting vaccinated now. COVID is hopefully largely behind us. So the profits of Pfizer have been reduced, and the stock price went from 60 to now 30. So it's possible that stock prices can go down. If you want to invest, the first thing you should do is open an online brokerage account. So there's a few options. All the big banks, Canadian banks, have an online platform. We've listed some here on the slide. So you can open an account and put some of your money in that account. And with that, you can either buy stocks. So you can buy single stocks, decide which one you like. Every public company has a symbol. 1 to 5 letter symbol. So you find the symbol, and then you can go on the platform and buy the shares of that company. If you're not sure about the single stock and the risk involved in buying just one stock, there are also what's called an ETF, an exchange traded fund. This is a basket of companies. So they put many companies together in one product. So when you're buying one share, in reality, you're buying a small piece in many shares of many different companies. So I put here the two biggest and the most popular ones in Canada is the XIU, which is the 60 largest companies in Canada. And in the US, it's the SPY, which is the 500 largest companies in the US. So you can buy one ETF, one product, and you get a diversified pool of all these companies. So there's no decisions made. They just buy the largest ones, and if the market goes up, these products tend to follow the market. They will go up. If the market goes down, they will go down. So they will follow the direction of the market. The other option is to buy mutual funds. So mutual fund is similar to an ETF, but in the mutual fund, there will be a manager, a fund manager that will pick the different stocks that he or she wants to buy. So instead of buying the 500 stocks in the U.S. market, the fund manager will only pick the ones that he or she thinks that are the best, that can give the best return over the next year, 5 years, 10 years, instead of buying all the big companies. There are different types of funds. So there are balanced funds, which would be a combination of bonds and stocks. So there are stock only funds. Like our fund here at Tonus, it's a pure stock fund. So we buy only stocks in Canada and the US. It's important to look at the return. So you can look at the history, how well that fund, that manager has performed over the past few years, and to look at the management fee. So for picking these stocks, the manager will charge a fee, and it's important to look at the fee. So you can do your work. There are hundreds of different funds with different classes, and you can really decide what kind of fund you want to invest in. Finally, some additional resources for you if you're interested in learning more about the market and stocks. I've listed 3 books here on the slide. They are quite easy read and introduction books to investing. So I would recommend the 3. A few websites to find more information on public companies. And you're always welcome to visit our website at tonuscapital.com to look at some of our writings and some of our views on the market. We always welcome comments or questions by investors. So contact us if you have any questions. Wishing you all a great year and finding great stocks in the year to come. Thank you very much.